Good afternoon. Welcome to Real Estate Raw. I'm Bill Ham with realestateраw.com. Thanks for joining me. So this week we're going to do a recap of the topic that we had last week, which we deleted, did not get recorded, and that is on the conversation of the cap rate interest rate inversion, right, that we see in our market today. So what happens when cap rates are below interest rates or when interest rates are above cap rates? What do we see going on in the market when this occurs, right? So that's what we're going to be talking about today. What happens when cap rates are below interest rates? And what we're saying is capitalization rates, right? When capitalization rates are below current interest rates. All right, I have done a lot of lectures and conversations and videos on cap rate. So if you want a full description of cap rate, you can go back over to my website, realestateраw.com. Go into the free resources. There's a lot of articles and videos in there. What I'm going to do today is just kind of give you a quick understanding of cap rate because I don't want to go down that rabbit hole too long. And then we're going to kind of discuss how that affects and works with interest rates. All right, so cap rate or capitalization rate. What we're discussing there is it's a multifunction tool. Cap rate does a whole lot of different things, but no one thing very well. And so what cap rate is, the formula is price or value divided by net operating income. Okay, net operating income is income minus expenses. That gives us NOI. And so you're taking that price or value, all right? So if we're buying the property and you're doing this on a purchase price, then your cap rate you're calculating is a purchase price cap rate. If you're just looking at values generally in the area and you're saying, well, these things should sell for this price or that price, then you're using value and you're creating a market cap rate. So either we're talking market cap rate or we're talking a very specific cap rate based on a purchase price and an NOI from a specific property. Either way, whether this is a market cap rate or a specific purchase price cap rate, what does it mean if the cap rate we're going into is less than interest rate? Very short, simple answer, you're not cash flowing. At least not at the moment. Does that mean this is a bad deal? Not necessarily. Does this mean we should not buy properties that don't cash flow, or should we never buy a property that has a cap rate lower than the interest rate? Not necessarily. Not enough information is what I always like to tell everybody. But short answer, if your property has a continual operational cap rate that is below its current debt service interest rate, yeah, you're not going to cash flow. So this is not a situation you want your property to stay in for any length of time, right? So now what we're kind of discussing is value add. So some of the best deals that I've ever done, and Monica, I'll introduce Monica here in the chat, is sort of a great friend and been with me for many years, asset management, property manager, expert, and she and I have operated a lot of property together. And I forgot where I was going with that. But anyway, so cap rate decompression, that's what I'm saying, value add, right? So this is value add. You're coming in, you're buying a property that does not cash flow or make money day number one. The property where I met Monica when I first bought it and wound up hiring her as a property manager some years ago was negative cash flow, and I believe the asset was about a 2 cap rate, right? So go back to the formula. Price divided by NOI gave me a 2 cap rate. And you would say, well, gosh, that's horrible. That's really expensive. Yes, but not enough information. The cap rate was 2 because of the net operating income was super low due to the occupancy being super low. So where I'm looking at this property, and it was I believe about a $4 million purchase price, and the revenue being at 60% occupancy, when I did that math, gave me a very low cap rate, like 2. And so right there, people would come in and say, well, gosh, what a bad deal. No, it was a great deal because I was able to buy that property at $4 million at a 2 cap rate, 60% occupancy. And within about 6 to 8 months, Monica and the rest of the team had the occupancy up. We had renovated, we had raised rents, and we had brought the occupancy all the way up. So what occurred was that ratio to my purchase price went from 60% to 95%, and that cap rate went from 2 to 10 or 12 or something like that. And then about 18 months into the deal, we sold the property for a 7 cap rate. So I went from 2, operated and decompressed through the rent growth, NOI growth, up to about a 10, a 12, whatever it was, and then turned around and recompressed at sale at a 7 and made a whole lot of money. And that is why you can't live and die by cap rate, nor can you live and die by the fact that cap rates today may be lower than the interest rate. But in the short term, that means that property's not cash flowing. So when you're doing your analysis, you need to be looking at that deal and saying, well, if there's a cap rate interest rate inversion here and the interest rate is lower than, or higher than the cap rate, is this something that's going to change in the very near future? Is this value add? Am I going to be able to renovate or bring the rents up or lower expenses or something like that and bring that cap rate or NOI above that interest rate? And if the answer is yes, then you only have a temporarily distressed asset. Then your property is only temporarily going to be in this inversion situation. And those can be great deals. Those can be really, really, really good deals. I was just talking to Josh Stull, who joins us here a lot of days in these events, and he's from Atlanta, and I've known Josh for quite a while. And Josh and I were literally just talking, saying some of the best deals we've ever done never cash flowed. Didn't cash flow, never did cash flow, right? That wasn't the point. They were renovations. We sold them at great capital gains or refinance, things like that. But we were able to, get out of those deals with capital gains. If you're buying something for a hold and operate legacy wealth, you're going to put this in the portfolio, you're going to own it and operate it for 2 or 3 or 4 years, then you need to be able to get that cap rate above interest rate quickly. And I would say within a year at best, and 6 months at best, right? And if you cannot see that that's going to occur, then what you need to do is pay a whole lot less for that property. Because if you're going in, and let's say you're looking at this property is from 1965 or something like that, and you're buying it at a 4 cap rate, the likelihood that you're going to decompress that cap rate through rent growth is not great, right? That's a very low cap rate. So you would have to have some other way of increasing the NOI significantly to get the cap rate above today's interest rate, which you would probably have in a loan of 7 or 8%, right? Meaning your cash on cash would have to go up to 8, 9, 10% before you start making money. So that is why we're seeing a lot of properties that don't pencil out and don't work from the income approach today. What you're doing is you're saying, if I'm going to the bank and borrowing 80% at 7% interest rate, then the deal doesn't work. Exactly. That's because that cap rate, its operational cap rate, is lower than the current interest rate. This was different 3-4 years ago when you could go in and get a 3%, 4% interest rate. Cap rates were always above interest rate. Even if you were buying a 4 or 5 cap rate property, which the majority of my career, a 4 or a 5 cap rate property meant it was like marquee, A-class, brand new, beautiful downtown building, would sell at a 5 or a 6 cap rate. 4, we never even heard of a 4 until recently. But that's what, so an older building, 1970s, 1960s, those were 8 caps and 10 caps. Well, what we saw is over time, people started to overvalue the value add model, and they started to compress those cap rates. And that was by paying more for the asset without really raising the NOI. And then you sell the property to the next person for a profit, they pay more, but you didn't really raise the NOI much. That's cap rate compression. And each time, if you're only increasing the revenue a little bit, but the price goes way up due to the market, that's cap rate compression. And the cap rates got so compressed for a while that it was they're getting very, very low. But that's okay because the interest rates were still also very low, and they were they were still lower than the cap rate. Even if the cap rate was 5, interest rates 4, you're good, and we're going to do value add, and we're going to raise rent, and that's why all this is going to work out. And they did. So the buyers went in, they bought these properties for a cap rate, and they went in and they raised the rent, and then the feds raised the rates, and it was a net nothing. And then they raised the rent, and the feds raised the rates, and it was a net nothing. And so that's what happens with cap rate. They went in and they did decompress their cap rate through rent growth and operation growth. The feds increased the interest rates, and then now you're kind of in this big pocket, little pocket match with the Federal Reserve, and that's not where you want to be. And so that is what has occurred in the market. So going forward with the interest rates the way they are, for these properties to make money as far as cash flow is concerned, you're going to need to get the cap rate above the interest rate. How are you going to do that? Well, it's either going to be by paying a whole lot less for the property, getting the price down, or it's going to be about borrowing a whole lot less money. You're talking 50% loan to value or something like that, or the interest rates going back to 3%. Yeah, if you're waiting on interest rates to go back to 3%, good luck to you. It's gonna be a minute, but maybe that'll happen. So that's where I'm kind of looking at a lot of this, going, yeah, we've got an inversion right now, and that's due to overvaluation of a lot of these buildings. And it is that math and those metrics that I'm kind of saying, hey, we're looking at a market shift and probably some pretty heavy devaluation coming soon to some of the assets, not all. I think a lot of the older buildings see space, and you've all probably listened to me talk about that. The older buildings are probably going to see some rapid cap rate decompression. But I also think that's where the opportunities are really going to lie, and you're going to want to be watching that. We kind of talked, I think it was 2 weeks ago, I did an episode on the 5 top cities that have the most debt maturity coming and all that. Those are the cities you're going to be looking at, right? Not running away from, running into, because that's where the deals are going to exist. Where's all that maturity. So again, for today, the point here is simple answer: when interest rates are above cap rates, you're not really in a net positive cash flow position. So that is something you either want to avoid or have the ability to reverse quickly. How would you reverse that? Through value add, through raising the rents or cutting the expenses. It's getting the NOI up. And if you have to kind of really do all these crazy things to get the NOI up, we're going to renovate and raise the rents and cut expenses and all this magic stuff, you're just increasing the probability of failure. All you're doing is just increasing the risk. So my real answer, my real suggestion is just pay less. I know right now that's hard to do, and I understand it's easy to say, and I understand that a lot of the sellers are not accepting those lower prices right now. Sit tight. Everybody's kind of in a standoff. We've got all these people out here with loan maturities, CapEx hitting. They need to sell, but the bank just extended their mortgage, and they can't really get the price that they wanted anyway, right? So we're in this kind of gridlock. As long as the lenders are in this extend and pretend mode, we're going to struggle to get deals done. We're going to be using a lot of creative financing and things like that. But the number one thing I'm telling everybody today, just be patient. Don't rush the market. Be patient. Learn your underwriting and make sure you know what you're doing. Speaking of underwriting, let's take a word from our sponsors. Me. We're having a live boot camp coming up here May 4th, 5th. I just want to let everybody know. Be my first actual boot camp that I'm putting on. I've always been at everybody else's boot camps and taught. So May 4th, 5th here in Tampa. That's going to be in Ybor City, where we're being hosted by the Tampa RIA. So 2-day event. Make sure you get information on that. We can put a link in the chat here, and it's also on my website. Should be good. It's going to be a creative financing and underwriting 2-day event, heavy on math, calculations, doing all the stuff that we do in here, live events. So hopefully look forward to seeing everybody come out to that. As always, if anybody needs any asset management help or help with their properties, if you're running things, if you have any issues like that, you certainly can reach out to Monica or reach out to myself. We both have asset management skills and can help you. Monica is in the process of growing a very successful business where she is now a multifamily asset management and bookkeeping consultant. So if anybody needs help in that, certainly reach out to Monica. Market's tough. I understand that. Everybody got to stay patient. Don't chase deals. That's the one thing I'm telling everybody right now. Don't chase deals. It's not the market. Sellers aren't selling at the price you want. Just be patient. Sit tight. It's going to shift. And you'll be rewarded for that in the future. But if you go chasing deals and you go buying, properties with this cap rate inversion thing, and you can't solve that quickly, as I like to always say, everybody, that is not a forecap. That is a foreclosure, right? You can't do that. If you're going in and buying properties at those kind of cap rates, if it's not some kind of really big value add where you're really bringing the rents up within a few months, you're probably just simply overpaying for that property, and you're going to have to actually fight hard to get those values back down and push that down. So that's going to be tough going forward, but that's going to be the art. It's where we're moving from the speculator market into the operator's market, and that's just how it is. So you're going to have to learn how to kind of operate and collect your rents. So that's what I have for you today. Cap rate inversion, interest rates above cap rates. You're not really cash flowing, so either avoid that in your analysis, or somewhere in your analysis you need to have some sort of value add that's going to convert that back to the other direction. But even in value add today, be very careful that you're not pencil whipping your deal, right? You're not just creating a bunch of numbers on a piece of paper that are not obtainable. All right, so Bill Ham, realestateRaw.com. Hope to see you all out there. Check out the website or the link. We'll put a link in here for the upcoming boot camp. And if anybody needs any help, certainly reach out to me. I am Monica. We're right here. Can get your questions answered. All right, so appreciate everyone stopping by, and I will see you next week. Hey, thanks for checking out that video. If you'd like more information like this, or you'd like to find out how you can work with me directly, go to realestateraw.com or just click the link below.